For more on the banks and their performance on Wall Street, Stephen Nash from FIG Securities. Stephen, there's a lot of oversight still playing out in the US. The latest to be a responsibility fee.
Yes.
What is that designed to do that provisioning hasn't already done?
Well, I think it's designed to possibly provide a general buffer in the event of another financial crisis. Some of the firms have paid back most of their TARP money and expect most of the banks to pay back the full amount, but there could be losses in the insurance sector and maybe the car sector. So the idea is to get a general fund together, I imagine. And
this fee would be a long-running thing, or if certain conditions were met, that would lapse? I mean, is there a sense on how that would play out?
The proposal is for the fee to go for about 10 years at this stage, raising around $90 billion US. So a substantial amount of money. So it is a long-term plan. I think the thing that markets might be concerned about now is this the end of regulation? Is this the end of taxation? Or is this the start of something? Are there other proposals that could come up? And how will that affect growth? How will that affect the banking system?
Are we talking an opt-in over this, or this would be a mandatory requirement?
At this stage, it appears mandatory.
Right. What about the dynamics of getting something like this through? We've seen the healthcare reform now jeopardised with a Republican taking over that key buffer that Obama did have in the Senate. Does it kind of cast new doubt over whether he can get these things off the ground?
Look, I think it's going to be difficult for people to oppose this type of approach to the banks. To oppose it, you're effectively siding with the banks, and that's not popular at the moment.
So what about siding with the growth story in the US and saying, well, hang on, actually, you fetter ingenuity?
That could be a way to counter this proposal, yes. It could be played out in the sense that it's damaging for growth. And I think right now it's a very important time for the US, and anything that damages perceptions about growth is crucial.
We've seen, though, have we not, though, in the junk bond space, lessons very quickly forgotten. Some fascinating figures. In the high yield bond market just last week, $11.7 billion raised by companies, the biggest in history, Stephen, even pre-GFC. What do you make of that?
Well, we've had quite a substantial contraction in credit spreads, and I think people are taking advantage of that. So I suppose we're at a point where either two things could happen. The equity market could fall away again, credit spreads blow out, so companies can't issue again, or growth continues to go well and the Fed tightens, so we've got rates going up either way. So it's people are sort of rushing to issue right now.
And yet the companies that are rushing to issue, unlike the banks with that explicit guarantee behind them now, or implicit, call it what you will, that knowing that the government won't let them fail. We're talking about companies that the likes of Fitch Ratings lowered the ratings on, talking about that violate the covenant on their credit facilities. They then go to the bond market, they are oversubscribed, and they could be technically in default based on what the credit rating agency says.
Well, basically this is, companies are able to do this given the improvement in sentiment. I mean, basically investors are much more comfortable than they have been. If this had been occurring a year ago, wouldn't have been able to get these deals away.
But who lends money on a 9% interest with a very real likelihood of default? That's my point. Who takes up that debt?
Well, a lot of institutional investors look at those sort of securities and balance the risks and returns.
But they don't look at the Fitch ratings and say, or the S&P ratings in this case, and say, hello.
They look at ratings. Ratings are important, but we've seen
they're mandated by ratings, aren't they?
Yeah, they are to some extent, but we've seen problems with rating agencies, I suppose, haven't we? I think a lot of people are sceptical of any rating at this stage. So they look through the rating and look at underlying fundamentals,
Okay. Look, what about the underlying fundamentals of a retail bond market here? This was doing the rounds last year, but now it's kind of got a little bit more traction with the Johnson report that's come out into financial regulation. What further steps along the road are we at now with this report?
Well, the Johnson report appeared to be very similar to the CP126 released by ASIC recently, and that emphasised that there's a need for a retail bond market in terms of investor requirements. There's also a need in terms of issuer requirements. Issuers here are really dependent on wholesale funding and bank debt, and the retail debt side of it is quite low, very low. Even a company like Tabcorp, for example, has quite a low exposure to the retail funding.
So how many more reports, Stephen, until the government gets the message?
Well, I think they've come a long way very quickly, but they probably haven't gone the full amount at this stage. But from a non-recognition of the problem to this is quite a big step. I suppose it's one step at a time. Yeah?
What would be sort of the firewall over this? You've got an entity like the ASX very keen to see business still churning through its system. Do you sense a kind of a lobbying march now about to take place with vested interests pushing against this proposal?
Look, I think that generally both the Johnson report and the CP126 have mentioned that bonds should be issued and traded in the retail space in a listed format, but globally bonds trade OTC or over the counter. So we would say that the market should really determine where these bonds should trade, and the retail market should possibly exist in both.
Have you got a sense on timing for this? This is an election year. Is it something that the government will dabble with before they've got a new mandate?
Look, I think the timetable for CP126, I think it's around April that class orders might be issued. So we will see some real changes soon, and I think it's very encouraging for the retail market.
All right. Encouraging signs on growth on a broader footing, Stephen. We've had, of course, employment numbers out here. We've had retail sales. We've had the inflation gauge. And when you look at all the numbers together, a position for the Reserve Bank being what?
Well, I think that the momentum that was caused by the stimulation last year is still with us in terms of the local economy, and that if the global situation stays the way it is, that momentum will continue for the first, second quarter, and that will probably lead to more tightenings. The problem for the bank is that, the Reserve Bank, is that the local banks will probably load that tightening. So if it's a 25-point tightening, there might be higher mortgage rate tightening because of the cost of funding.
You don't think that the heavier moves than expected by Westpac, for instance, would signal that perhaps we've reached a plateau from the bank's point of view?
I think we're getting close to that. I'm not saying that we're going to have unlimited amount of tightenings. I think maybe one or two tightenings further, and that's about it. And that really depends on this global outlook, which at the moment looks very fragile.
And as the IMF was only just saying a few days ago, look, governments, and let alone Reserve Bank, stimulus, remove it gradually. Don't just pull back. Don't be frenetic. Stephen, we must leave it.
Okay.
Appreciate it.
Thanks very much, Cousin.
Stephen Nash from